Well, good morning, everyone. Welcome to this workshop preparing for the State Housing Tax Credit and Contribution Fund Program. Minnesota Housing Partnership is very excited that all of you could join us this morning. This is a program that MHP and many of you advocated for a number of years at the Minnesota legislature, and we were excited when lawmakers enacted the program in 2021, and it goes into effect for this 2023 tax year. So I want to make sure that we have time for as many questions as that all of you have. So I'm going to jump right into our speakers. If you have a question, feel free to plop that into the chat. We are going to save questions until the speaker is done with their presentation, and then we'll open it up for some questions. Whatever I can answer, or some of the other guest speakers can answer in the chat, we'll do that as things are moving forward, but just know we're not going to interrupt the program for questions. We'll save those till the presentation is done. We have a great lineup from speakers from Minnesota Housing, the former Commissioner Mary Tingerthal, Tom Johnson from Mahoney is going to talk about some of the tax implications. Then we have a legal perspective from Erin Mathern at Winthrop and Weinstine. So I'm going to turn it over now to Krissi Mills from Minnesota Housing.
Hi, everyone. Apologies for my voice. It's not great today, but I'm pretty sure I can make it through. All right. So my name is Krissi Mills, and I'm the program manager for the State Housing Tax Credit Program and Contribution Fund. Next slide, please. At Minnesota Housing, we believe in our mission. We offer products that support the development and preservation of affordable rental housing through both financing and long-term asset management. Minnesota Housing also offers products and services to help Minnesotans buy and fix up their homes and stabilize neighborhoods, communities, and families. Thank you for being part of our mission. Next slide, please. The State Housing Tax Credit Program is a new way to finance multifamily and single-family housing. Funding for this program is unique because there are no state or federal appropriations. The program is entirely funded with eligible Minnesota taxpayer contributions. In October, Minnesota Housing began accepting applications for contributions to the Contribution Fund. In 2023, $9.9 million in state housing tax credits are available. Unused tax credits do not roll forward into the next year. Eligible taxpayers can contribute at least $1,000, but not more than $2 million to the Contribution Fund per taxable year. With that contribution, the eligible taxpayer may choose to designate a specific qualified project to receive the funds or contribute to the general contribution pool. In return, the taxpayer receives a state tax credit certificate that equals 85% of the contribution, which the taxpayer may use to reduce their state tax obligation. All contributions are irrevocable. Next slide, please. Here's an overview of the process of issuing a tax credit certificate. Taxpayers may apply for tax credit certificates online through a CVent survey until December 8th, 2023. Taxpayer information, including taxpayer ID and contact information, must be provided in the application. If you are making a designated contribution for a qualified project, information about the qualified project must be included or must be provided in the application. If you want to see a list of what questions are on the application, we do have the form on the website that you can view. When the application is submitted, Minnesota Housing staff will review the application, and if it's accepted, we will send you the taxpayer certification and signature page with the payment instructions via DocuSign. Once Minnesota Housing staff have sent the DocuSign envelope, the taxpayer must sign the document and submit the funds within 30 days or by December 29th, 2023, whichever is sooner. After receiving funds and signed documents, Minnesota Housing will send the tax credit certificate to the taxpayer at the address provided in the application. We also share that information with the Minnesota Department of Revenue. Next slide, please. At the time of contribution, taxpayers will indicate if the funds are for a specific project or the general contribution pool. For this presentation, I'm going to focus on designated contributions for rental properties. When the taxpayer makes the designated contribution, they will provide information about the designee that they want to receive the funds. When the agency receives the designated contribution, our staff will notify the designee, and the designee will request the funds from Minnesota Housing. This request process will include submitting the due diligence checklist and supporting documentation, including information to confirm that the property qualifies for funding under the program, and confirmation that the designee is eligible to receive funds and is not a disqualified individual or a disqualified business. The project must close and a loan agreement must be executed within 24 months of Minnesota Housing's receipt of the designated contribution, unless that time frame is extended by Minnesota Housing. If a project just doesn't close or is otherwise deemed infeasible, Minnesota Housing may add the funds to the general contribution pool and award them to other eligible projects. Next slide, please. Eligible recipients of the funds include cities, excuse me, federally recognized tribes, tribal housing corporations, private developers, nonprofit organization, HRAs, public housing authorities, and the owner of the housing. Next slide, please. The next few slides deal with disqualified individuals and disqualified businesses. An award will not be provided to disqualified individuals or disqualified businesses. Before applying or requesting funds, all recipients must sign a disclosure that disqualifications do not apply. I'm not going to read the entire statute to you on the next couple of slides. It is available on our website and it's also available in the program guide. But our understanding that the intent of the statute is that a taxpayer cannot receive both the benefit of a tax credit and also receive a loan funded by the contribution. We recommend consulting with a qualified tax professional or legal professional if you have questions about disqualified individuals and businesses. And we're going to continue. You guys have been submitting some questions to us about this topic. So we're going to continue to update our FAQs as we receive and answer questions. So that's available to everyone. Next slide, please. All right, so this is the definition of disqualified businesses. And can we move to the next slide, please? There's also information in the guide and in the statute referencing the Internal Revenue Code and for determining ownership based on the taxpayer and their spouse's interests. So that information is available too. Next slide, please. Okay, program requirements. Contributions will be used to provide funding for loans for eligible multifamily and single-family housing projects throughout the state. Eligible uses of funds include gap financing, new construction, acquisition, rehabilitation, demolition or removal of existing structures, construction financing, and permanent financing. The funds must be used to serve households at 80% of area median income for rental housing projects and 115% of AMI for home ownership projects, except for that set aside for households whose income is 50% AMI or below. Next slide, please. Funds will generally be provided in the form of a 0% loan with up to a 30-year term. The interest rate may be adjusted to allow these funds to be utilized with other sources of funding or resources, such as the federal low-income housing tax credit. The loan term may be adjusted based on the requirements and conditions of other funding sources related to the length of the loan term. Loans may be forgivable unless the terms of the loan agreement are not met. Rental projects financed through designated contributions must be leased to qualified households who must disclose their annual household income at initial occupancy on an initial occupancy statement. Each adult member of a household occupying an assisted unit must sign and date a Minnesota Government Data Practices Act disclosure, which tells the tenant that their annual household income and other information will be reported to Minnesota Housing and may be reviewed by other governmental agencies. Owners must submit an annual certification that the project has complied with the income and other statutory requirements of the program. Next slide, please. Finally, I want to make you aware of some program resources that are available on our website. Information about the program can be found in two places. The State Housing Tax Credit Program and Contribution Fund website contains the most detailed information, including the program guide, example documents, the FAQ, statutory references, and we have some new marketing materials. There's a digital postcard and a one-page flyer that have been created and available on this page, and there's also a version that is formatted for printing. The Contribution Fund website is a simplified website. It has a shorter URL that contains high-level contribution information. Communities or developers have the option to direct potential contributors to this website with a shorter URL to learn more about the contribution process and a link to the CVent application. From here, I will pass it on to the next presenter.
Thank you, Krissi. I do think we have one question in the chat for you. Deshana is asking, can a developer purchase state tax credits and contribute them to an HRA if they are a developer in a project that have no ownership?
Let me take a look at that one and type up a response. Okay, Skip. Thank you.
So next up we have Mary Tingerthal, the former Commissioner of Minnesota Housing. Mary, I'm going to turn it right over to you.
Very good. Well, good morning, everyone. I'm glad to see such a good turnout this morning for this important new resource that we have for housing. It's been a while since I've been in front of this audience, but it's really good to be here. I'm excited about this opportunity to bring an additional amount of money into our affordable housing ecosystem. It seems like it was a very successful legislative session last time, but we always need housing in Minnesota, and this is another resource, maybe a little more flexible than some of the others that you may use in the projects you're developing. Next slide, please. I'm going to repeat a few things that Krissi mentioned just to give a little more detail. So the statute authorizes $9.9 million in credits annually for the next 6 years, including this year. The credits will actually support $11.6 million in contributions each year. And I've shown the math there of how you then get to 9.9 million. One thing you should know is that the authorized credits do not carry over from year to year. So that means if there are less than $11.6 million in contributions this year, just in the next 2 months, those credits that would be associated with that will be lost forever. So that's why we're coming to you somewhat urgently today to get your attention and have you think about whether there may be ways that you as a developer can attract contributions to this fund. And we'll talk more specifically about how you may do that. As Krissi mentioned, for 2023, taxpayer contributions must be, the application must be submitted by no later than December 8th. They'll then be reviewed by the agency, and the funds must be received either within 30 days if you do the contribution earlier, or by no later than December 29th of this year. Next slide, please. So what are our challenges in getting the word out? I've been actively talking with various people I know as individuals or as corporate leaders for about the last month since I became aware that these credits would be available really only for a very short time this year. And I'll tell you that I've found that informing and motivating potential contributors won't be as easy as I thought it might be. Why is that? Well, the credit is new and frankly, kind of unexpected. When I've talked to people, some of them have said something like, really? Is that true? I've never heard of this before. So we have a little bit of an education climb in front of us. Secondly, the credit is a kind of unusual structure. We have the example of North Dakota, which is where we learned about this credit, where it was successful for a number of years. But it's hard to point to similar examples in other types of credits. Third, financial professionals that advise taxpayers are largely unaware of this credit. And so they won't be coming to their clients and say, hey, you really should use this credit if you can. And we know you've contributed in the past to housing. So there might not be much marketing from that standpoint. One of my theories is that having the ability to do contributions for designated projects may be a really important factor in getting contributors to come to the table in this very short time period. As I talked to my own financial advisor, they said, well, this is all really interesting, Mary, but nobody's really going to come to the table simply because it's a tax credit. And you're going to need to talk to them about why they would want to even think about making a contribution to housing. So that was a sobering thought for me. And that's what spurred me to action and puts me in front of you today. Next slide. So this feature of the program that allows for designated contributions, I think provides a real opportunity for developers to attract those contributions. First, I would encourage looking at the forms, et cetera, because it really is for contributors a very easy process. I have to give hats off to the agency for keeping it simple, and for the taxpayer, there just isn't a lot of work they need to do. But if you want them to make a contribution to a specific project, you'll need to help them understand that they'll need to check the box for a specific qualified project on the application. And you'll need to provide them with some minimal information about the project, whether it's single family or multifamily, the project name, and some brief project information, just enough for the agency to understand and clearly know which project is being referred to. Some information about the developer, owner, administrator that is developing that project. And with that, the name of a specific individual that will be the contact person for that developer or owner with their email address and phone number. That's how you'll learn about the fact that a designated contribution has been received. And if the contributor happens to be affiliated with the project, a description of what that affiliation or participation is, because the agency will need to determine whether there's any conflict with that disqualified individual or business provision that Krissi talked about. Next slide, please. The nice thing is that there's nothing to prevent you as developers from telling potential contributors about projects for which you would like to get designated contributions. But what that means is on your part, you need to really think about what's in your pipeline, what are projects within your organization or your ownership that might be good candidates to appeal to contributors and that can utilize the dollars within 24 months. So the questions that occurred to me were, first of all, are they qualified projects? And we'll go back over that in a second. Secondly, are the projects likely to have all the funds they need to close the project within 24 months? Remember that Krissi said you need to have entered into a loan agreement, deferred loan agreement with the agency within 24 months of the contribution being received. So you need to think about that time frame and whether the project is positioned to have all of its other funds within that time frame. And finally, and frankly, which projects are likely to appeal to potential contributors? Then you need to think about how you want to inform potential contributors about the projects you've decided on. You may have individuals that you could reach out to directly, and that may be all that you want to do. You may have some real targeted investors within your community or within, perhaps if you're a nonprofit, within some specific donors that you know have contributed in the past, that they might be interested in an additional way to contribute to a project that's being developed by your organization. And then secondly, for a process that Minnesota Housing Partnership is providing, there will be the ability on the MHP webpage to enter information into a Google Doc form, and that's right, the link is right on the webpage, where you can put in that basic information about the project, and it will be listed. We'll be working over the next couple of weeks to have it perhaps be a little bit more user-friendly, but that Google Doc is available now, and the list will be available shortly on the MHP webpage, frankly, as soon as we get the first project listed. Next slide, please. So just a reminder, what is a qualified project? The sentence that jumped out to me in the guidelines was this one that's in quotes here. It must result in new housing units or fund rehabilitation of existing housing units for persons and families of low and moderate income. So it really is a bricks and mortar project, but it can involve the financing of that bricks and mortar. It can be either new construction or it can be rehabilitation of existing housing. So the eligible uses, which Krissi talked about, are pretty broad. And I suggest you take a look at those if you have any questions about whether the project you're thinking about is eligible. I really do suggest that you use the email information on the agency's website to send your questions in as soon as possible. Libby talked about those that are eligible recipients and that it must serve low and moderate income households. I did confirm with Krissi that you do not have to have all of the units in a project be income eligible, but the benefits of any dollars that you do get in a mixed income project must be attributed to the units that are affordable. Again, if you have questions about that kind of detail and nuance, I suggest you contact the agency. Next slide, please. So these are just my ideas, but as I was thinking, if I were a developer, what kinds of projects might I look to for that might be appealing, that might make a good use of these dollars? The first might be just frankly a few affordable projects that have most of their resources secured, either from local resources or because they received dollars from the agency in the past, but they still have a gap. And this might close the gap to get them to closing. Another category that I thought of was workforce projects, particularly in greater Minnesota, where maybe you're not currently thinking about providing any affordable units, but if you were able to use these dollars to essentially write down the rent levels for the number of units you need to qualify the project for TIF or other local resources, that might be something to run the numbers on and see if that can work. Rehabilitation projects. Maybe you have a great building in greater Minnesota, a senior building that is doing just fine, but frankly, it needs a new elevator and you don't have enough money in your reserves to be able to pay for that elevator right now. That might be an appealing project to people in that area where their parents might live, and could be a real local appeal if you have projects like that. And it's something where you wouldn't necessarily have to bring other dollars to the table other than your reserves. And finally, I know that recently the agency issued its early no letters on the 2023 RFP. So you might want to look at a project that you're thinking of resubmitting next year and seeing if the additional dollars might improve your position for that project next year. Next slide. Finally, and Krissi gave these links as well, I do encourage you to look at the Minnesota Housing webpage. The FAQ document is really detailed, has a lot of very helpful information. And as Libby said, as Krissi said, they'll be updating that on a regular basis and moving forward as you ask your questions, those will get added to the FAQ. The MHP website also has a more detailed program description that you might find helpful if you have captured the attention of a potential donor and they're looking for just a little more detailed information. Some other initiatives at MHP and other organizations, including Greater Minnesota Housing Fund, which has helped to sponsor this webinar. We're looking to do some media. The agency has already started doing social media on this project. We've made some corporate contacts with Greater MSP, the Itasca Project, American Council of Life Insurers, and Chambers of Commerce. And we intend to reach out to financial professionals such as tax advisors, financial advisors, and financial planners in the next 2 to 4 weeks. Coming up next are two experts that we've asked to address some of the more technical aspects of this. We'll hear first from Erin Mathern, who will address particularly some of those issues around disqualified individuals and disqualified companies. And then Tom Johnson will join us, and he's got some elegantly simple tables to show you just exactly how this credit works from a financial standpoint. Thank you very much. Erin?
Hi, good morning. Can you hear me? Great, good. I'm Erin Mathern. I'm an attorney at Winthrop and Weinstine. And Mary and Libby asked me to talk a little bit about the legal considerations with respect to the state housing tax credit. So I'll say at the outset that I am not offering legal advice this morning, but some thoughts about how we might navigate the provisions both of the statute and of the program guide as we move forward with the state credit. So I'll talk a little bit about the questions that we are receiving most frequently on the state credit, and then just give a couple thoughts about perhaps how it can be best used. I would say at the outset that this is really an evolving topic in the sense that the program guide that came out relatively recently from Minnesota Housing gives a lot more insight into how the agency is viewing the contributions and interpreting the statute. And then the FAQs are also very, very helpful. And I'm glad that Krissi mentioned that those will be expanded, because I think there'll be some increasingly specific questions as individuals and businesses start to make their contributions. Libby or Jenny, I'm wondering, could we go back to the slide in Krissi's presentation that shows the statutory language on disqualified individuals and businesses? Because I think this is important. Yeah, perfect. And go one more forward to the one about businesses, please. There, thank you. So this is a question we're getting fairly often from clients and others, in the sense that, you know, folks want to know if they're involved in the affordable housing business, this community that we're in, can they both make contributions to the fund, and can they be working on projects that would potentially utilize some of the proceeds from the fund. And so I appreciate that Krissi mentioned that the idea is that broadly an individual or a business can't be both a donor and a recipient. But I think that the way that the disqualified business language in particular is written, maybe gives some ability for interpretation there, because we know, of course, that when we structure affordable housing transactions, and in particular those that receive low-income housing tax credits federally, that is not an uncomplicated structure. And so when you're trying to determine what is an individual or a business's role in that project, it can come down to asking some very specific questions about the project and the structure. So the thing to point out first, I think, is that when we're talking about disqualified individual or disqualified business, we are talking about those in the sense that they are disqualified from being the recipient of the credit, or being the recipient of the benefit of the credit. So the loan in this case from Minnesota Housing. And in the program guide, that entity or individual is called the designee. So in this case, the notion, I think broadly, is that you can't both make a contribution and then go to Minnesota Housing and ask for a loan of the funds. But I think the way that it's written is both a little confusing, but also, gives some more insight into what our legislators were thinking about when they drafted the statute. So when we talk about a disqualified business in particular, and in this case, we're talking about the business who would be the recipient of the credit. So if you're doing a low-income housing tax credit project, this would be, for instance, the partnership that would own the project. So in this case, then a business or a project owner is disqualified if that business itself made a contribution to the state housing tax credit fund, either in the current or previous year. And then we get a little more specific. We say, or if it wasn't the business that made the contribution, then does that business have an officer or a principal who made a contribution in the current or previous year? Or is that business owned, controlled, or is there an individual in that business that can vote 20% or more of the votes in that business who made a contribution in the current or prior year? So I think the idea is that the controlling entity of that business or that recipient of the loan or the credits can't also be a contributor. But we all know that the way that entities are owned and controlled when it comes to tax credit and affordable housing transactions often doesn't stack up as clean as the language is drafted. So I don't have like a definitive answer on, whether or not in all circumstances you can be involved both on the contribution side and on the recipient side. But I would say that this is very much a facts and circumstances kind of a test. And I think that's the reason why when it comes to making the contribution and also receiving the loan, individuals and businesses are asked to attest specifically to whether or not they are disqualified. And so, whoever's advising you from a legal or tax perspective should probably weigh in on this question if you're thinking about ways to fill gaps in projects, to maximize your own individual state income tax liability for affordable housing. It really is specific to the project and the way that project is set up. I would also say that there is just a note that's a reference to the Internal Revenue Code that talks about how there can be sort of constructive disqualification. So this concept that like if married individuals are making contributions, those contributions are attributed to one another. And there are also other Internal Revenue Code rules. You can read 267C4, or your lawyer or your accountant can help you interpret it. But it essentially says that if you are making a contribution, then that contribution can also be attributed to certain family members. The other thing that I would just point out very quickly is that we're in a very interesting year for the state credit in the sense that Minnesota Housing has not started accepting contributions until now, right? Until fourth quarter of the year. I think that to many of Mary's points, leaves a lot of really good opportunities in the sense that if you're talking to potential donors or you're considering being a donor to the state credit fund, you can make your contribution for 2023 now, and you can receive your credit and claim that credit when you file your tax return in 2024 for your 2023 taxes. So, if most individuals file their return fairly early in the process, so, sometime between January and April, then you'll be able to claim your credit on the contribution that you made at the end of the year. So that time that, folks are probably thinking about where they would have to make the contribution, but then they'd have to wait to claim the credit, sort of that bridge period is quite short for credits in 2023. So this is a really unique opportunity for folks to give this new credit a try and be able to receive the benefit of it fairly quickly. And then one other point, just to point out, is that the credit doesn't have to be taken all in 1 year. So you'll get a credit certificate for, in this case, 2023, but you can carry forward those credits for up to 10 years. So if you can't personally use 100% of the amount of the donation you made as a credit, you can carry it forward. So hopefully if there are folks out there who are considering donations that are larger than their annual Minnesota state income tax obligation, know that you can claim the credit in subsequent years as well. So that is the extent of what I have to say this morning. Obviously, I think we're all staying on to answer questions, and I'm very interested to hear what Tom Johnson can tell us about how this credit will actually work in application.
Thanks, Erin. Can everyone hear me? Yep. So I'm Tom Johnson with Mahoney, a CPA. Mary asked to just run through with a quick tax credits. And as a tax credit go, it's a relatively simple, it's really quite easy, so for our donors, there is a mission component to it, right? You're going to lose 15 cents on the dollar. Not lose it. It's a charitable contribution, sort of, I would call it. And you get credit for that 15-cent charitable contribution on your federal tax return. You can go to the next slide, please. But overall, it's a pretty good basic, relatively easy tax credit. Eligible contributors, I think we went over it briefly, but it's really any person or corporation or business subject to Minnesota income tax in general. The tax credit is 80% of the amount of the taxpayer contributed to the fund during the year. And, this is important. The contribution amount used to calculate the credit. So if you donate $10,000, that $10,000 can't be used to claim any other Minnesota deduction or credit. The federal benefit, there is a federal benefit to this, but IRS regulations require that the deduction for the contribution to the fund be reduced by the amount of the tax credit received. So I'll show an example of this in 2 slides. Next slide, please. I think Erin mentioned this, but I'll just reiterate it. The tax credit is non-refundable. So what that means is that the credit cannot exceed the taxpayer's liability, but the excess can be carried forward for up to 10 years. Claiming the credit, this is mentioned by Mary and Krissi as well, but it can only be claimed after Minnesota Housing has certified the contribution, and you must file a copy of the credit certificate with your tax return. Reiterate the timing again. This has to be applied for by December 8th, so it's a relatively short time frame. But a great benefit that Erin mentioned as well is that you get to see that credit returned to you within a couple months versus waiting a year. So the time value of that money is a little more positive in this year for 2023. A Couple other quick things: non-residents and part-year residents of Minnesota must allocate the credit based on their percentage of Minnesota income over federal income. So you only get to claim a portion of that contribution. Tax credits granted to partnerships, LLCs, S corps are passed through to their partners, members, based on organization documents or their partnership percentage. There can be special allocations as well. And tax credits, unlike LIHTC and rehab tax credits, are not subject to recapture, which is a good thing. So on the next slide, I have a quick example. So let's assume a taxpayer has a $10,000 tax liability in 2023, and they want to make a contribution to the fund to reduce their Minnesota tax liability. Another assumption, the taxpayer itemizes their deductions. I'm not sure how you have a $10,000 Minnesota tax liability and in the 37% income tax bracket, but the math worked, so we used it. But in order to reduce the Minnesota tax liability, I did 100%, you would have to contribute to the fund $11,765. That would give you a tax credit of $10,000 and result in a net liability of $0. The federal benefit, so there you get a state benefit of $10,000. The federal benefit, I mentioned before, you have to reduce your contribution by the amount of the tax credit. So in this case, the tax credit is $10,000. So you get a federal charitable deduction of $1,765. If you're in the 37% tax bracket, that's a federal benefit to you of $653. So in terms of really the total benefit, you know, you donate or contribute, I should say, $11,765 to the fund, you'll get a benefit back of $10,653. It's about 90%. The federal benefit varies a lot, so it's hard to say everyone will get a 90% benefit, but you'll get at least 85% benefit through the state, which is a really great deal. I know a lot of the nonprofits raise funds already for specific sites. This is a better deal as far as taking a deduction back on a tax return. There are a lot of mission-oriented people that would, I think, contribute to this, and you can designate it to certain projects. So it works out pretty well. Next slide, that's it for my part.
Well, thank you, Tom. So let's see, I gotta stop sharing my slides here. I'm gonna open it up to questions. I know that there's been several questions that have been asked in the chat, and if I think some of the presenters are hopefully trying to answer some of those to the extent that they can. But if there's additional questions that haven't been asked in the chat and you want to raise your hand, feel free to do that. Otherwise, a lot of questions directed, I think, towards the agency. I'm going to start at the bottom here. Jackson is asking, is there a scoring guide to receive the tax credits, or is it just first come, first serve on how the tax credits are given out? And then as the developer, at what point after we apply are we guaranteed the funding? Is Krissi still on?
Sure am. Okay, let me read that question again. Sorry. Is there a scoring guide? So the application for the tax credits, that's first come, first serve this year. So that they can fill out that CVent, and that's kind of what puts you in line for the tax credits. As the developer, at what point after we apply are we guaranteed the funding? So we're developing a due diligence checklist that the recipient would complete, and you'll submit that, and that's essentially what tells us that your project qualifies to get the funds.
All right, thanks for that. Mary, you want to add anything?
There was a question from Bill Magoo who said, "You mean this means that my dollars are leveraged about 9 to 1?" And that's correct. Even without the federal, if I make a $1,000 contribution and get $850,000 back, that means the impact of my $150 is actually $1,000 for the entity that's developing the housing.
Yeah, and
So,
I think Chris Flood put another comment in the chat of like it is somewhat dependent upon your tax circumstances. So we do advise you to reach out to a certified professional to get guidance on what exactly would mean for your own tax liability, both at the state level and the federal level. But I think one of the things that Tom was alluding to is if you already have people who are giving money, this is a way to incentivize them to give more because there is a benefit and the benefit is greater than potentially what they're getting currently through the federal deduction that's only available to them. Another way to frame it for those who, it is a way, yes, there is, you don't get a full dollar for dollar on this, but it is a way to direct your tax dollars. And so that is an attractive framing for some people and some businesses of you're going to pay these dollars anyway to taxes. And this way you get to say that you want to contribute to affordable housing. And so that in that framing, there's not exactly a loss. So just some things to think about as you're talking to potential contributors.
there's a question that Krissi just answered, which I think is an important one from Jenny. It is not necessary to submit your project that you want to get designated funds for to the Housing Finance Agency in advance. You can simply designate to your potential contributors that this is the project that you want funds designated for. So that's why it's important if you're going to be communicating with potential contributors that you be pretty specific about the name and the location of the project so that it gets allocated to the right place when the contribution gets to the agency. However, if you are a developer whose project receives a designated contribution, you have the obligation that you will need to fill out the developer checklist to demonstrate that you have all of the funds that you will need in order to complete that project. So whether it's the development of a single family home or it's a development of a multi-family 100-unit building, you have to demonstrate that you have all of the dollars you're going to need to close on that transaction. So it's going to be a wide range of what's required depending on the type of project that you're doing. One thing I should know is that there is no jeopardy to the contributor if for some reason the project for which the dollars were designated happens to not move forward. So let's say, despite your best efforts, you're just not able to get that project closed within 2 years. Simply what happens to the funds is that they move into the general contribution fund, and they'll be distributed by the agency through their normal RFP processes. So there's no obligation on the part of the contributor to necessarily make sure that that's a qualified project or any of that sort of thing. That really is in your hands in terms of telling people about what projects you would like funds designated for so that we don't end up with designated funds that end up going to the general contribution fund. So I do want to emphasize that for the contributor, once they make the contribution, they're done with their obligations. They don't have any obligation to make sure the project gets done. That really falls to you and to the agency.
Chris, I see your hand up.
Yeah, thanks. Just wanted to follow up on Mary, your comment about developers have to have all the funding together to ensure that a project will close. So does that mean illustrating that the project will have a path to have funding together within 24 months, or have 100% of the funding secured the day of the contribution?
It's certainly not secured on the day of contribution. No, that is not the intent. I'm going to let Summer jump in here. She's a veteran of many an approval projects. So Summer, maybe you can give a little more.
Hi, everyone. Summer Jefferson, Minnesota Housing. Just try to hop on since Krissi's sick. Yeah, so for the contribution component, none of the financing has to necessarily be available. However, obviously once the designation comes in, that's when the 24-month clock starts to tick. So from just getting a project to closing, it would be probably better for the designation to come in once the funds are probably already committed to the project and the project is potentially further along, just to get so that you can close within that 24-month period. So,
yep, thank you.
One follow-up to that is, how has the agency determined how it's going to treat designations? So if a project gets an early designation and they don't have other funds lined up, but they're planning on applying through the RFP in the next year, have you clarified how you're treating those contributions when they come in for other funding?
So they'll receive, the project will, once they get a contribution in, we'll actually send a letter to the project saying you've received a contribution. Here's what you need to do in order, and the checklist that you need to submit to get to close within this 24-month period. They could use that letter and submit that to the consolidated RFP and use that as for leverage, financial readiness. In addition to that, we've also talked about or discussed that some of the investors, if you have an investor that's going to commit to the project, they could actually sign a letter to the RFP saying that they're going to invest in the project, $1 million to the project. And then inevitably, once later on in the process, once you're selected for the RFP, you could actually submit the designation the following year when the project is probably closer to closing, or in the next couple years, submit the designation through the state housing tax credit. So there's two different ways that it can go. There's different ways that we can connect. Obviously, if they don't necessarily contribute to the designation, they still have to, the $1 million commitment is still there from an RFP perspective for the project. But we figured that people would want to know that the project was selected before they actually contribute into the state housing tax credit, the designated contribution. So that's another way that folks can get a commitment. But does that make sense?
Yeah, thank you. I just wanted to clarify, and so folks know that nothing precludes you from going in, getting contributions on the early side of things, but it is 100% up to them to get everything else put together. So I want to see, I hope Erin is still on to get back to this question from Skip. I know Krissi was going to give it some thought, but Erin, you might have your legal perspective.
I can say a little bit about, I think Erin mentioned it, and Erin for sure can follow up, but I think she mentions that we are getting a lot of questions generally about different types of structures. It is very hard. I think it will be contingent on the actual final structure of the project. So on the front end, when you're trying to give the agency, we're not trying to give advice to contributors of whether or not they would be precluded from receiving a contribution. We definitely are saying that you should talk to your tax professional or your legal professional, but it does depend on what the final structure of the project is going to be. And we'll receive a lot of that information once the project submits the documentation. And so, happy to have more conversations about it. But again, it's something that you really will depend on what the structure of the project will inevitably be. based upon what Skip's question, it seemed like it, in general, it seems like it was a turnkey developer type of project where you're not going to be involved in the ownership at all, then that seems relatively that you would not be precluded from contributing or receiving the contribution if you're not even a part of the ownership. But again, I would, if you have any concerns, I would definitely check with your legal counsel or your tax professional. So
yeah, I agree. I'm looking back at Skip's question. And I think the answer, I mean, my opinion on this is that if the contributor didn't have an ownership interest in the project or in the business entity that is the owner and recipient of the funds, then I don't think you would have an issue with the disqualified business, disqualified individual question. That seems pretty clear to me. I agree with Summer. Can I
go ahead, Erin?
So I have a question. So I think, and this is for Summer and Krissi, I think that most of us are thinking of this, the funds coming from the program as being additive to projects. But I have gotten the question, just because I certainly have clients who have applications into Minnesota Housing who don't know if those applications will be funded, but haven't received an early no. And the question is, you know, if they secure a contribution to that particular project, will Minnesota Housing view that as like an addition to the capital stack that would reduce Minnesota Housing's like financial commitment to the project? Because I think we are all thinking of this as additive. And I just want to make sure that the project specific contributions wouldn't be viewed by MHFA as a reason to pull back funds that would have otherwise been contributed.
that's a great question. I don't think it's something that we've considered. However, I think in this market, with the changing, everything is changing day by day, with interest rates, with credit pricing, with just costs in general. The chances that what you would be or what we would be approving is going to be modified are high, and that additional funds coming to the table to help with those are always great and needed. And so I think it's something we can go back and take a look at. But again, most of the projects that are getting selected are being modified substantially. So additional funds are great, in that I wouldn't necessarily be as concerned about us reducing our funding, just because the market right now is just so volatile. But
yeah, I mean, it would be fantastic for developers to be able to view this as additive to their project, to be helpful with those things that are changing like by the day when it comes to rates, construction costs, et cetera, not reductive in that they're still going to have a gap. So all right, I'm done talking. Thank you though. That's a good answer. Thanks, Summer.
Great. Libby, before you wrap, I do want to remind people that if you've been inspired to identify projects for which you will seek designated contributions, there will be a place on the MHP website where there will be a list of projects if you submit them. So if you are interested in using that as a place where you could send potential contributors for the information about the project, so that they have the information that they can cut and paste into the application form, please make use of the Google Doc form. There is a link on the MHP website that will take you directly to that form. It's very simple, it's very straightforward, and Libby has also put it in the chat. So thanks to MHP for offering that service, and I'll turn it back to Libby.
So thank you, everyone. This recording will be made available. We will send it out as part of a follow-up email along with the slides, and then we'll also put all this information on our website. There's a lot of questions that I don't think were fully answered in the meeting chat. So we will do our best to answer those and get that information out, most likely through our website and a follow-up email. But those are being captured as part of the reporting. And so we will try and work with Minnesota Housing to get you answers to those questions. So I just want to thank everyone for spending your morning with us, and feel free to follow up with me. I'm going to volunteer Mary and Erin and all of our presenters, I think, are willing to take your questions after this presentation, as well as Krissi and Minnesota Housing, of course, are willing to take your questions. So thank you so much, everyone.